Good evening, ladies and gentlemen. It is Tuesday, the 20th of December 2022, and welcome to Foresight, where we learn to read some tea leaves. In this series, it's going to be the opposite of our hindsight series, which is where we look at trades that we've taken for the day and analyze what we've done and see what went right and what went wrong in order to better improve our trading. In this series, we're going to take a look at potential setups in the future, what may or may not work. And one thing I want to stress about technical analysis is that it does not determine what will happen, but what is likely to happen. The purpose of technical analysis is to use charts to determine risk versus reward. I think that's something a lot of people, especially on YouTube, don't mention, is that we'd be lucky to get a 50% win rate in terms of being correct or incorrect. But the idea of technical analysis is to identify the best possible entry for a trade in order to maximize reward and minimize risk. If we're correct 30% of the time, but we risk $1 to make $10, then that is an extremely profitable venture in the long term. So keep that in mind. Nothing I talk about here should be taken as financial advice. I'm not recommending you to buy, sell, or do anything with any stocks. I'll simply be looking at some charts and talk about some trades that I may or may not take. In this case, I did take a trade today on BHP, and this setup was meant to be a starter for today and an add-on for tomorrow and the day after potentially, so we'll see if it ends up working out. But the idea here for BHP is this setup here, where it consolidates at the highs for anywhere between 12 to 15 candles, and then performs a large sell-off. Now, how large that sell-off is uncertain, but we can see historically this setup where it creates new highs. So we can see a new high is made here, consolidation for a certain amount of candles, and then a sell-off over a very quick period of just a couple of days. We see it again here, just a large sell-off preceding a 14 candle consolidation at highs. And we can see it numerous examples. This extends even further into the past, where we've got consolidations after creating new highs into a large sell-off. But keep in mind, this isn't just over 2 or 3 days or anything like that. This one's a little bit longer, where it does end up selling off, coming back into range, and then doing a 5-day sell-off. And then we have another little example here after creating highs as well. So the idea of this setup is identifying that every time a new high is reached, that when it consolidates, it tends to sell off. That's just a pattern BHP has, and other mining stocks as well. This extends to Fortescue and Rio Tinto to some extent, but I find the charting a little bit cleaner on BHP in this example. So we're not particularly certain how far the dip is, but we can see that it extends to 5%, 8%, 15%, and 10%. Now, these sort of happen during sort of the more volatile times where the larger percentage gains drop, and we end up with, let's say, 5% as the benchmark for this trade for myself. So, and that's 5% from the lows. And what we have in this case is a gap into consolidate, and hopefully the sell-off will begin tomorrow. So one thing I want to point out is that I did have this set up here. I was actually tweeting about this one a week or two ago whenever this setup was happening. And this ended up breaking out here. I can't remember what the fundamental news was. Sorry, I do remember. This was on the day that China said they're potentially easing restrictions. They brought out some news that they're having a conference about easing restrictions. That there was a breakout here because iron ore prices rose as well. And then on this day here, we had the Federal Reserve making some remarks which caused the market to be bullish as well. I think they mentioned, Jay Powell mentioned the easing of restrictions. The easing of rate rises to be specific. So this did end up consolidating and pushing out on 2 fundamental news announcements. So that setup idea failed. Now, I did take a trade actually on this day here. I bought some puts. Thinking that perfect entry, but unfortunately it did break out and the fundamentals pushed it, plus Jay Powell on top. So it's unfortunate. I also didn't realize I had the adjust on. So this adjusts for dividends. So if I untick that, you can see it didn't actually make new highs or even retest the highs. it was down here. So adjusting for dividends kind of maybe was unfortunate in this situation, but either way, we'll leave the adjusted for dividends on, and I still think the trade has some potential, which is why I took some puts for today. Now, the idea was that because this is about 13 candles in, there's an opportunity for 14 or 15 candles to develop to the upside before finally collapsing. So I'm spreading out my options trades. Hey, look, if it works out today, my entry for today, and it just collapses, fine. I'm going to make some good money anyway, albeit nowhere near as much as I'd like. But for me, it's all about spreading it out and just getting the better entry where I possibly can. I'd rather spread out the entries, take a little bit, and get better and better entries over time, rather than putting it all in one go, just for my options to devalue pretty significantly if this rallies over the next 2 days. Because what I'm taking is short expiry options, because the play really is a short-term move to the downside. So to give you an idea of how short-term, this expires on the 29th of December. So Thursday, the 29th of December. And the puts are for $44.14. So $44.14, that's the strike price. And I paid 14 cents or 14 and a half, but basically 14 cents. So the break even is going to be $44. And to give you guys an idea of how options work on expiry day, if you don't know what the value is or you're struggling to understand the concept, on expiry day, if the strike price is $44.14, like these options are, so we got $44.14, and we paid 14 and a half, let's say 14. The break even is going to be $44.14 minus what we paid, so which is 14 cents. And then every 14 cents that this drops further is going to be a bag of profit. So let's say, just to round this number out, let's say it was $500 worth, just to keep it simple. So every 14 cents below $44 that BHP goes to, there's an intrinsic value behind the options. This is not including time decay. This is not including volatility, which all builds into the price. But on expiry day, the simplest way to measure this is you've got an intrinsic price, and every 14 cents, there's $500 of profit. 500, 500, 500 every 14 cents. So that's just one way to grasp the profit potential. And then if we put in $500 at 14 cents, that means we're risking $500. That means we can't lose any more than that initial premium of $500. So I hope that sort of gives an idea of the potential. So if the stock drops, and let's just bring out the ruler. So from the base, we're looking at let's say, what was it, 5%? Let's say 4.99%, which gives us a price of $43.32. So we got $43.32 minus $44.15. That gives 83 cents of intrinsic value. So 83 divided by 14 cents, that gives just under 6 bags of profit for the trade, irrespective of how much options one holds. So keep in mind that there's also going to be the volatility aspect, which increases the premium. So the option won't be worth that 83 cents. That's the intrinsic value, is 83 cents. If it drops in the next couple of days 5%, that intrinsic value is going to skyrocket. It's not going to be 83 cents. It could be $1, $1.20. It's hard to say because it is a calculation. And I'm not aware of how that calculation, in depth of what that calculation is. And I'm sure I could find out, but it's a little bit too tedious. I'm trying to keep this simple. And also there's time decay. So if the stock goes sideways for the next 9 days until expiry, the option value is going to decay. So it's going to be worth less and less and less and less every day. And if the stock rallies to the upside, it's going to be worth even less. It's going to significantly reduce the price of the options, which for anyone not holding is going to be good. Because if you're looking at getting a better entry price and the stock is rising and you're still anticipating this move, then great, you're getting a much, much cheaper option. So if one gets the 44.14 options at 7 cents, they're going to make twice as much money as I am with my 14-cent options. So I hope this kind of explains roughly how options work. I know it can be a little bit confusing, but given some time, it kind of makes more sense as you sort of dabble in options. So the idea here is for a quick, sharp drop on the back of this setup. So I've already explained sort of the setup and the conditions for the setup. And now it's just a matter of the next few days seeing if BHP can manage a sell-off of at least 5% in about 3 days. That'll be ideal. And if it doesn't, then I just lose my premium. Realistically, if this starts going up, so over the next couple of days, if it goes up, I'm likely not going to buy $44 options, probably going to be more like $44.50. And then hopefully the push will come to the downside. So that's the idea of the trade. And if it starts tanking over the next few days, then I'm not going to buy more options because, like I said, volatility will kick in and the premium, the price of the options will rise significantly, meaning it's just not worth it to buy, right? The volatility aspect really amplifies the value of the options, which is awesome if you're holding options, but if you're looking to buy, it's useless because you're just paying a sick premium to get in on a trade that you don't know if it's going to keep going or not. So that's the idea behind this trade. And we got the option at around this time, around 10:45. And the thing is, the reason we picked 10:45 is because the stock rallies for about an hour. So if we look historically, if we zoom out, BHP rallies on the opening session so often. And when it gaps up, it does a little pop first and then a sell-off. But BHP is very consistent at morning rallies. So I think out of the last like 10, 12 days, there might have been one session where it didn't rally in the opening hour. And even if it sells off in the first little bit like here, it still ends up rallying to about 10:45, 11 o'clock. So BHP has just been really strong in the opening session and then coming off in the afternoons most of the time. So same situation, wait for it to rally for 45 minutes and up to 11 o'clock, so up to an hour. And enter the option there. And if it kept rallying, the idea was to take the options traded around 12:45 to 1 o'clock in the morning, which is also a familiar timing with BHP. And then, of course, we've got tomorrow. I'll look to add on if the stock goes green, and then the day after that, look to add on again and at different expiry prices as well to make up for the fact that 44.15 might not be a good target if the stock rallies. And if we bring up the daily chart, if the stock ends up rallying to, let's say, we get unlucky, it goes to $47, then I wouldn't be too crash hot on having $44 puts, maybe $44.75 or $45 puts, be more reasonable, just to increase the likelihood of it getting hit. And of course, I'll pay a little bit more and get a little bit less as a result of a safer trade. But it is what it is. Now, I just want to keep in mind, you guys, that this is a degenerate trade. By every metric, this is a degenerate trade. Short-term expiry is sort of gambly in nature. I've had pretty decent success on my CBA puts. You've probably seen my other videos on the CBA, the Fortescue puts. And I don't take these very often because it's not very often that I have a good setup that I'm willing to take. And this is a setup that I've been watching for the last couple of months. I've been waiting for this to happen on BHP. And I've identified it and found an opportunity, so I'm taking it. The alternative is, of course, also taking shorts on it. So one can take shorts on it and risk the overnight. I'd rather not hold thousands of shares of BHP. I would rather just get a few bucks in options and risk $500-600 to make potentially $6,000 with $500 risk, $600 risk. It makes sense to me rather than risking this gapping up overnight and holding a short position. I could scale and build into a short, but this is really a very specifically timed trade. If anyone wants to take shorts on it, I guess that'll be potentially the safer trade depending on how much you're risking. The question there I've got is, well, where's your stop loss? which isn't as obvious. So we got also the Oz 200, and I've got the price here at where it closed today. So on the closing price here at around 7,032, and these are the futures, so they're still live and going. And you can see after it closed, where is it, around 410 around here, and we can see the market just rallied, pulled back, retested the closing price, and rallied again straight through VWAP. So futures are actually coming back, and this is a fantastic reason for me not to hold the trade overnight. A risk like this, that it gaps up. So with this, what happened here is Bank of Japan came out and said they're tightening restrictions on lending. I don't know the details specifically behind that, but effectively the Bank of Japan was one of the last dovish banks out there. They've turned hawkish, and the markets sort of panicked in response. So we can see that on the US 500 or the US 30. Same sort of thing, same sort of sell-off. And we can see on the JP225 USD, which is the Nikkei, that they're still suffering. So they haven't recovered like the XJO or the Oz 200 or the US. So this is the idea behind the trade. I think it really helped, obviously, start the breakdown. This wasn't hinging on a fundamental event happening. This was just a technical setup that has happened multiple times in the past, so it didn't rely on a fundamental event. It's just a coincidence that it happened at 2 p.m. today and caused sort of a bit of a breakdown. And we can see Rio as well, and FMG having, like I said, they've got very similar chart setups as well. So they're sort of doing the same consolidation at the highs, and they've done it before at the highs. And then you've got FMG, which of course is pure iron ore as well, which is looking like it's at support. But a pretty nasty day overall, and it wouldn't surprise me if FMG, bounces again one more time for maybe 2 days and then comes off, and then sort of perhaps causes some movement with BHP and Rio Tinto as well to the downside, and they'll likely move all together at the same time. But where you've got support on FMG and where there's support on Rio Tinto, may provide some holding up of BHP for a couple of days. So we've got probably a very weak level here. I wouldn't expect this to be very strong at all, but there's no real significant level on Rio, and BHP broke its level, albeit briefly, but it did either way. And it also bounced, or going to bounce off this $45 level potentially. So again, it's there's no guarantees here. This is just a setup that I've seen before, and really just hoping for the best. We've got a risk defined already, and we've got a reward that's well above 5, and risking 1 for 5 at a bare minimum for this one. So that's the trade, that's the idea. If you like it, let me know what you think, and I'll catch you guys in the next one. Cheers.